Hey everyone, welcome to this explainer. Today, we are literally pulling back the curtain on a fascinating piece of research called the Sovereign Financial Fortress. We're going to be decoding the invisible rules of money. We'll explore the exact frameworks the elite use to protect and multiply their fortunes. And honestly, more importantly, how you can use this blueprint to build your own sovereign financial fortress.
Okay, so let's just dive right in by fundamentally challenging that old, tired advice we've all been handed. You know the script, right? Go to school, get a stable job, stash your cash in a traditional bank account, and just sort of hope to retire in 40 years. Well, the analysis we are looking at today argues that this script isn't just outdated, it's practically a guaranteed path to financial stagnation.
All right, part one, the broken script.
You see, decades ago, the economic rules completely shifted. We moved away from hard assets into a system driven by debt and inflation, which absolutely broke that traditional script. Just look at the contrast here. On one side, you have the 99% playbook, the linear trap that most people are stuck in. They're working for wages, saving depreciating cash, and acting as passive consumers. But on the other side, the 1% playbook, the institutional mindset. It doesn't save cash, it accumulates assets. It creates networks that generate yield. It's a completely different exponential game.
Moving on to section 2, the invisible tax.
Now you might be wondering, why exactly is saving cash such a losing game? Well, it all boils down to this fascinating concept called the Cantillon Effect. This economic theory explains that when new money is printed, the entities closest to the source, like massive corporations and banks, they get the benefit first. By the time that money actually trickles down to your everyday wages, prices have already skyrocketed. So inflation isn't an accident. It's an invisible, unvoted tax that is literally devaluing your labor before payday even hits your account.
To put that into perspective, holding cash is basically surrendering your wealth. Think about this. If you had saved $100,000 in cash 10 years ago, today that exact same amount buys nearly 40% less real estate, food, and energy. 40%. Real wealth is measured by what you can actually buy, not just the nominal number sitting in a checking account. That's exactly why high net worth individuals absolutely refuse to hold cash. They store their value in scarce, appreciating assets.
And this brings us to an absolutely crucial tenet of the wealthy: capital velocity. The institutional mindset refuses to let their money just sit there gathering dust. While traditional advice might tell you to park your cash or, buy depreciating liabilities like luxury cars, this blueprint argues that a dollar should never rest. The very second capital hits your account, it must be strategically stripped into an investment vehicle so it can immediately start producing its own income.
Okay, section 3, the institutional playbook. So how do we transition from just earning income to actually managing assets? It's all about creating asymmetric advantages. First up is geographic arbitrage, earning in a really strong global currency while living or running your operations in a lower cost economy. Next, we have skill arbitrage. This is taking highly complex tech, like AI for example, and selling it as a super simple, high-value solution to someone who doesn't quite understand it. It's kind of like being a highly paid tech translator. Finally, we've got intellectual property and digital monopolies. Modern wealth is built on owning digital content and software. These are assets that cost practically nothing to hold, but possess infinite scalability and generate pure, high-margin cash flow. Then we have the third pillar, which is structural protection. And the golden rule here is simple. Own nothing personally, but control everything structurally. Starting at the operating company, this is what generates your active, high-velocity cash flow. But then, those profits are immediately funneled into a holding company, which acts as a centralized vault to mitigate your risk. Finally, your true wealth is housed in an asset trust for generational compounding. It creates this impenetrable legal shield that completely separates your personal liability from your financial engine. Which brings us to section 4, the math of wealth. Now, most people try to build wealth linearly, right? Like 1 + 1 = 2. But to scale exponentially, you really need to understand the velocity equation. And hey, don't worry, there's no pop quiz coming. It simply states that your exponential equity equals your initial capital multiplied by 1 plus your efficiency rate, all raised to the power of your compounding frequency. This isn't just high school algebra, actually scratch that. It's the literal mathematical formula for escaping the rat race.
To make that equation explode upwards, you've got to tweak 3 specific variables, what we'll call the 3 dials. Dial 1, optimize your efficiency rate. You do this by integrating software and AI workflows so your business can handle 10 times the volume without adding more human labor. Dial 2, increase your compounding frequency.
don't wait an entire year to reinvest your profits. High-growth entities spin that reinvestment loop by recycling profit margins back into the system within weeks. And then, dial 3, radical scarcity acquisition. Deploy that capital into prime real estate or equities with untouchable competitive moats. By turning up these 3 dials, you force that geometric curve drastically upward. All right, our final section, Part 5, the Sovereign Blueprint.
So, bringing it all together, we have this escalating 3-phase actionable strategy that you can start applying today. It kicks off with Phase 1, capital capture. You have to ruthlessly cut out low-leverage manual work and focus heavily on capturing value in global digital marketplaces until your active income is 5 times your baseline living cost. Once you hit that, you enter Phase 2, system isolation. Here, you build what's called an ammunition pool. This is liquid capital sitting in premium vehicles just waiting. When the markets inevitably correct and everyone else panics, you use this ammunition to acquire generational assets at a massive discount. And finally, Phase 3, sovereign autopilot. This is the dream. This is escape velocity, the stage where the yield generated by your assets completely outpaces your active earning power, giving you absolute, uncompromised freedom.
Everything we've looked at today really drives home one major point. The modern financial matrix kind of thrives on you remaining a passive consumer. But once you clearly see these invisible rules, once you truly understand the hidden tax of inflation and the sheer power of capital velocity, you have a responsibility to yourself to change your strategy. You have to stop storing your precious life energy in paper money that a central authority can just print out of existence. It's definitely time to shift our focus from just looking wealthy to actually acquiring undeniable sovereign wealth. So if this explainer opened your eyes today and got you rethinking your entire financial foundation, I want you to leave a comment below answering this one vital, defining question for yourself. Are you holding cash or are you acquiring assets? Let us know down in the comments, and I will see you in the next explainer.